Good afternoon, everyone. Today I wanted to talk to you and I wanted to share the event that happened to me. I was sitting with a client and they told me that when they left their job, they thought that their insurance would carry over. They thought that their life insurance policy, because they had group life insurance policy, they thought that life insurance policies were their own. They thought that they were the true policy holder. Actually, if you work for a company or you work for a business, and just say you want to be like her, you wanted to be an entrepreneur, and business was going good, things were going great, and you decided to uh, further your business opportunities by becoming an entrepreneur, going in business for yourself. And you may have a good job with great benefits, and you may have also opened up a life insurance policy. Many times, not all the time, but many times when you get insurance through your business or through your company that you work for, the policyholder is actually the company that you work for. They own that insurance policy. And one key thing that I like to share with you so that you can understand is that you want to have your own individual life insurance. And I hear a lot of people say things about no whole life, just term, just term. Another key factor is I always would suggest that you diversify your insurance. Granted, I don't think you need a lot of whole life insurance, but that's my opinion. I think you only need just a little bit, but that little bit should cover at least your final expenses. And your term, that's when you got larger obligation, when you're younger, you want home enough if anything happened to you, especially if you're the main breadwinner. You want to make sure you leave your kids in good condition if you have kids or your spouse. You want to really have a good, robust amount of life insurance. But as you grow older and as you progress, then you want to take a look at your portfolio. And typically, term life, you may buy a 5-year, a 10-year, a 20-year, or even a 30-year term. But just think about this. Say if you're at the age of 20 years old and you buying term life dirt cheap. I mean, it's pennies. And it's a great plan. But if you're not aware, they take a look at the time that you have that life insurance from that age all the way up, all the way back to 20. And then they take a look at how much will the cost be. So you may have term, but what happens when you turn 50 after that 30 year? Then you have to go back and buy some more additional insurance. Now you're buying it at the age of 50 versus the age of 20. So the rate will be higher because the likelihood of you passing away, the risk is higher. And insurance is basically calculated risk. That's all it is. It's calculated risk. So if you now buying at 50 and say you do a 20 year, because it's a little bit higher, it's going to be quite significantly higher in comparison between age 20 and age 50. So now you got it at, just say, 20 years. Now just say you're blessed and you live and now you're 70. Now you need life insurance. See, this is where the whole life kind of comes into play, where it really makes sense to be diversified, to be balanced. Granted, if you have enough cash, you have enough accessibility to cash, and if you can budget yourself, you can become disciplined, you can save up enough to take care of your final expense. We got that. We understand. We're not talking to those people. We're talking to the millions of other people who live life and trying to make ends meet, and things happen in life. Car tears up, house, life, it happens, and you're not really financially sound. You live from check to check. So think about this. If you got whole life policy, maybe at the age of 40 or 30, imagine the rate of a whole life policy. It would be a whole lot cheaper. But now think about getting a whole life policy at the age of 70 or even a term. And some term will only go to a certain part or to a certain portion or age. Now, here you are, you've been paying term life for decades. And if anything happens where you may need that money, you may need those resources, you get nothing with term. What you're doing is you're putting something to the side And it's in hopes that if something happens to me, my family is covered. But with whole, you do build cash value. Now, some people say, well, the stock market is this and that. Well, you have fluctuation in the stock market. You have fluctuation in time. But this is money that you can also access. If something comes up or you need that money, you can utilize portions of that money as far as loans or what have you. And you're borrowing from yourself. You become your own instant bank. So it's just different options, different things. But just keep in mind, when you're with your job, take a look at your insurance. Take a look at the insurance that your company has, but also take a look at your personal insurance. So if anything happens, if the company closed down or if anything, they may move and then you can't move along with them. Anything could happen with a job, but they take that insurance plan with them. Or if, because the economy may be struggling, they may configure or change their insurance plans. Just keep in mind that they own the policy and you're just one of the participants of the policy. So that's one of the things about group life insurance, but I just want to really make it plain that really take a look at your portfolio, take a look at your financial portfolio, and take a look at your life insurance, and make sure if you're an entrepreneur, you're getting ready to leave your job, you definitely want to secure yourself some insurance, because especially as an entrepreneur, if that stops, your whole family, it is affected without your income. So one of the things to just keep in mind. Have any questions, you can definitely send me an email, and that's at rmajor07@gmail.com. Hope you all have a great afternoon. Take care.